My main task here is to put the recent gyrations aside and talk about the Australian stock market performance for the last 4 years and put that into a broader perspective. It's been the second best period in the last 20 years, notching up 4-year gains in excess of 20%, and it's actually been the only period where you've had 4-year gains of up to 20% or over 20% per annum in over 60 years. For the most part, these gains in the stock market, the Australian stock market, have been based on the soundest possible footings, which is earnings growth. From the bottom of the earnings cycle back in 2003, earnings are up over 180%, and the stock market is up over about 225% in that period. For the first 3 years of this 4-year cycle, there's been a very close and sensible relationship between earnings growth and share price performance. In the last 12 months, there has been a very sharp disconnect, which is quite hard to see on this graph, but much easier to see on this graph, where the valuation of stocks has sharply disconnected from the growth in earnings. Now, this is fairly typical of the late stage of a stock market cycle, and the stock market does have cycles. Investors do irrationally extrapolate the last few years' good performance indefinitely into the future, and you do get some rather painful short-term experiences. This disconnect has been reflected not only in share price performance relative to earnings, but at all sorts of other levels, in particular in relation to valuation. This chart is about the valuation of the ASX 300 industrials, so this is not including resources or bank stocks over the last 12 years. And what it does show is that valuations have well exceeded normal or average valuations. The industrials 300 PE at the peak a few months ago was over 2 standard deviations above its 12-year median, and now, adjusting for the recent pullback, it's actually come back to a more comfortable level. The market blow-off has been reflected in all sorts of other ways as well. The chart here talks about the performance of small resources and large resources against the broader market. There's been, as my son has reminded me constantly over the last two or 3 years, some spectacular gains to be had, Dad, at the small end of the resource market, and that's been reflected in the performance of some companies that certainly we wouldn't regard as being of investment grade, but it's not to deny the fact that people have made a lot of money out of those sorts of companies in the last 2 or 3 years. There have been several poor quality floats or floats of what would be generally regarded in a normal environment as poor quality businesses, but you can get those sorts of businesses away in a bull market. There have been several opportunistic capital raisings by companies that have left investors sadly wanting subsequently. And I talked earlier about the small cap resources performance, which is again fairly typical of the kind of environment you get late in a cycle. The theme of this conference is investing in a global world, and it's important to look at the Australian market in the context of the broader investing universe. And here our market's re-rating relative to the rest of the world does truly reflect our position at the epicentre of the demand, or as a main supplier, one of the main suppliers to the largest source of marginal demand in the last few years, being China and to a lesser extent India. So it is a strong reminder that stock markets are cyclical. We are right in the sweet spot in terms of demand for commodities. We've got some of the best and biggest commodity companies in the world in our market that represent nearly 30% of the market. As I say, 7 years ago, the world didn't want to know about our market because tech was in fashion and we had no tech. A year or so ago, less than 30% of the market traded on a PE, which is just your basic valuation metric. Less than 30% of the market, ex-resources and banks, which typically tend to be lower PE stocks, traded at greater than 18 times. Only 2 or 3 months ago, over 50% of the market traded in excess of 18 times earnings, which for a value type investor has made it a particularly difficult 12 months to find things to do with their money. There have been several style factors which have been obvious in the last 12 months as the market's growth has accelerated and it's moved away from an earnings-based market. Another reminder of the cyclicality not only of business but of markets is just the measurement of the movement, the cyclicality of return on equity. People kind of assume it's something that grows over time. If you actually look at return on equity as an investment tool, it is actually very cyclical. If you look at the bottom of the market or close to the bottom of the market back in June 2003, the market was capitalising very low earnings power of the market as measured by the return on equity at quite a low multiple. 4 years later, where the return on equity of the market overall, driven by, to a large extent at the margin cyclical resource stocks, the market return on equity is 700 basis points higher as the profit cycle is well and truly in full bloom. It's happy to capitalise those earnings at 200 basis points higher than it was at the cyclical low in June 2003. Again, reflecting this another way, profit as a share of economic activity has been well above previous all-time highs, and there's no doubt there's been a profit boom right around the world. The question is how much of this will be given back to labour as the cycle progresses. Again, just showing the cyclicality of return on equity. We are well above previous 30-year highs. They are, in a broad sense, the main points I'd like to make in terms of the underpinnings of what's been a truly stunning performance by the Australian stock market in the last 4 years. I've been asked to also make some just very brief comments in relation to the short-term outlook. The trend that's been evident is a trend that's been dominant for the last 7 or 8 years. The good companies have continued to get better as they've operated in good industry structures with very good management teams and very good balance sheets. Companies that operated in more marginal competitive environments with poor management teams have struggled. That's largely been reflected in stock price performances. Key risks in terms of the outlook for the market. One other point I'd make here is commodity prices. Australia has benefited in so many ways, and most obviously through the stock market, from commodity prices. If you look at the results from BHP and Rio over the last 5 years, from 2002, over 75% of their profit growth has come from commodity prices. You hear a lot of other noise about costs and volume growth. A lot of that profit growth has come from commodity prices. At this stage, it's not obvious when there may be a change to that, but it's worth noting that 4 years ago Rio made no mention about their bullishness about commodity prices, and 4 years later they're exceedingly bullish. There's always noise in the stock market. The one thing that wins out is stock picking. So good companies at sensible prices, that will always win out. There'll always be other opportunities. This last period of opportunities won't be the last.
As far as outlook for the Australian equities market. There's a few other areas that I might just touch on. John previously talked about resources, which I have a view on, which I'll cover. But also we might make the statement that equity managers tend to be reasonably optimistic when they talk about outlooks for equity markets. Why? I don't know. I think that we always look for opportunities, look for good investment ideas. And certainly that my discussion here today won't surprise that I am a little bit optimistic as far as the equity market is concerned, despite the fact that the market over the past few years has performed incredibly strongly. The reasons why we have seen a very strong market, I think, can be summarised in quite a few different headings. Why valuations, I think, have been reasonably supportive over the past few years. Earnings have been very, very strong indeed, and John touched on that, and I'll expand on that a little bit further. The reason why earnings have been so strong is underlying domestic and industrial relations. Market liquidity has been very plentiful. That's changed a little, but we'll talk about that a little later in the presentation. And resources, we've had a boom over the past 3 or 4 years, and the question mark is how long will that continue and can it last? I have a view which I'll express, and I'll touch on that a little bit later. And the other factor is that we've had a pretty stable environment here in this country as far as government and industrial relations. So let's have a look at the valuation of the equities market. This is the performance in red of the equities market going back since January 1990. And as you can see, the performance has been very, very strong indeed. From the low point in March 2003, the market has performed very, very strongly, averaging over 20% per annum for the last 4 years. But in that environment, we have seen the average price-earnings multiple of the market, despite the market trading at or near its all-time high, trade at or below its long-term average. So, according to looking at this chart in PE terms, the market is not overly excessively valued to our way of thinking, and certainly well below its previous highs in PE terms as far as the overall market is concerned. But like all things, charts and averages can disguise a few factors. There's always sectors which are cheap and expensive, and certainly that is the case as far as the equities market is concerned. John touched on the industrials. Yes, we do believe that the industrial market did move up quite substantially over the past 12 months in particular, and has been moving up progressively since its low point in March 2003. And you note that the average price-earnings multiple for the industrial market, excluding resources, is around 14 times the average since 1990. It moved very high. It moved up quite substantially over recent months, and certainly that the last 12 months it moved up very aggressively. And what was driving that growth in particular was the performance of very poor-performing companies, in our view, poor-quality companies which were revalued quite markedly on the hope that they'll be taken out by private equity or by others within the industry. Now, that certainly has reversed, and I think for the good, that speculation and associated valuations for poor-performing companies has come back somewhat, and good quality companies are now looking reasonably good value. Within that, the banking sector has underperformed over the past couple of years. The historical valuation for the banks suggests that banks over the longer term should trade at a discount to the overall market, but certainly the discount narrowed quite sharply a couple of years ago to the extent where it's now normalised. So the banks now look to be reasonably good value at a 20% discount to the overall market compared to their recent historical average over the past since 2000. We also have Real Estate Investment Trust. They've been quite incredible over the past couple of years. Last year to the end of December, I think they had one of their best years ever, and the market also had one of its best years ever. It is very unusual for listed property trusts to perform very, very strongly in a market which is rising strongly. It is normal. Listed property trusts tend to be quite defensive in nature, or have been in the past. A little bit different now because they've changed their makeup. But certainly that they perform very strongly, driven on acquisition growth in order to expand their funds under management, read earnings, and I think that the motivation behind a lot of these funds, and they had was to expand their earnings, and they also had access to cheap funds as well. But what we have seen since the end of December is the relative valuations of property trusts come back a bit to where I think to more normal levels, and to my way I think they should trade at a discount going forward. The sector which has been re-rated downwards, surprisingly enough, despite the fact that resources have been quite strong, has been diversified metals and mining. And that's despite the fact that the metals and mining sector has been very, very strong indeed as far as earnings are concerned, its cash flow and also its prospects. And our view is that resources should be trading at a slightly higher level than they are now, driven on very strong underlying fundamentals, which I'll touch on later in the presentation. Looking at the earnings growth been quite strong. I'll touch on that a little bit later because we've just completed our reporting season. The reporting season, or the results, were actually better than 13.5%, which I'll expand on a little bit later. But certainly what has been quite strong has been resources. And if I stood here 12 months ago and forecast what the market was forecasting where resource earnings would be for the 2007 year, the forecast would have been for earnings to be negative or zero. So there has been the view that, and similar to in the last 4 years, that earnings growth for resources has peaked or will peak this year, looking forward. And that's best depicted in this chart, which shows the forecast for commodity prices going forward. The black line is the actual outcome of commodity prices going back since September 1999, and it shows that commodity prices have moved up quite substantially. But every year looking forward by analysts, the forecast is for commodity prices to fall. back in December 2004, and that's what those lines represent, is always a falling trend in commodity prices. Our view is slightly different, and we'll expand on that a little bit later. Domestic growth, global growth, I won't expand on that too much. Been very strong. Australia's 16 years of underlying domestic growth, very strong indeed. Forecast to remain reasonably strong. A few caveats, one being interest rates, one being inflation in this country. But again, the view is that growth should remain reasonably firm over the next few years. As far as global growth is concerned, global growth has been very strong indeed. We have seen growth in the order of close to 5% globally, driven by the strong developing economies, the BRICS as they're commonly referred to, such as India and China, and I'll talk about that a little bit more later in the presentation. There is one concern, and that's the concern about the US economy. The US, it is, I think, a universal view that given the credit crisis, it is likely that the US will slow from here. That is our view as well. But we don't believe it will actually fall into a recession. We have a bit of a slightly optimistic view as far as the globe is concerned, and also as far as the US economy is concerned. Liquidity is another factor which I touched on, been very strong indeed. We have seen net new equity issues trend down over the past few years, and that actually has been a positive as far as the equities market is concerned. The other factor is we are seeing good external flows coming to the market from superannuation funds and the like, which again has been a positive driver. But the other factor that has been driving the Australian equities market as far as liquidity is concerned has certainly been private equity. It's probably best described in this chart here. What this chart does show is the return on equity that the Australian market has been able to deliver over the past years, dating back since September 1993, and it clearly shows the return on equity has been trending up. But at the same time, the cost of funding has trended down. So we've seen interest rates move down and also spreads move down quite dramatically. Now, that's yesterday's story. I think that what we will see, is we have been seeing, and what we are witnessing right now, is a repricing of risk, and those margins which contracted quite sharply will no longer be the case and will normalise over time. Now, let me just talk briefly about commodities. We do know that the growth has been quite strong for a number of years, as shown. If you look at GDP growth for the top 5 nations, United States, China, Japan, India and Germany. And you see the ranking as at 2005 and put a forecast of where you think global growth will be for the next 10 years at the rate of, in the case of the US, 3.1%. These are IMF forecasts, they're not my forecast. China of 8.7%, but it's actually been upgraded to 8.7 for the next 10 years. Japan at 1.8, India at 6.5 and Germany at 1.5. You see the relativities change quite dramatically. That come in 2015, if these forecasts are correct, that China will be number 1 as far as in GDP terms. So from a demand point of view for resources, it is very important because these developing economies do have a great appetite for commodities, and that was what we have seen in the past, and I think that's what we'll see in the future. And just to put that in perspective, again, if you believe that the story that growth will continue for quite some time, it is likely that commodity prices will move up further because the demand from China will be quite substantial going forward. Back in the early 90s, China represented around 10% of global usage. It is forecast that they'll represent around 35 to 40% of global usage come 2015. If you look at India, likewise, not by the same scale, but also picking up as far as usage is concerned, from less than 2% moving to close to 20% by 2015. So again, we've got 2 big driving forces which are driving commodity prices and usage up in our view. And at the same time, we have seen resource companies expand their capacity quite dramatically to meet up with this demand. They have been working flat out in order to deliver this demand. But the problem is we're running out of resources. There has not been any major new discoveries since 2000, and in fact what we are developing now is what was discovered in the 80s and 90s. So what's going to feed that is going to be difficult. So what that does mean is the supply-demand imbalance we believe will remain for quite some time, which suggests that commodity prices should remain firm for quite some time. The other reason is, and even if you do find a major or have a major discovery, the prospect of bringing that project on stream is very, very difficult. The reason for that is the industry is running at over 100% capacity. There is a shortage of labour. There's also a shortage of equipment as well. The length of time it takes to actually bring on just certain basic equipment, which is required for mining companies, has expanded quite dramatically. And one is, if you look at grinding mills as an example, where it was only 2 years previously, a waiting list has blown out to 4 years as an example. Let me just talk about the reporting season. Again, it's been a fantastic reporting season, relatively speaking. The July forecast was for earnings to grow by around 13.4%. The end result is that the earnings have been better than that. It's been bettered by about 4% is the latest figures. These were as at last week, where earnings growth were in the order of 18%. One of the trends was that interest rates expense has increased a little bit for industrials, but less so for resources. Wages have been pretty well under control. Payout ratios remain high, and also buybacks have been quite substantial as well. So all these factors are actually still quite positive as far as the equities market is concerned. What does it all mean from our point of view, and what has changed from what I indicated from the beginning? What has definitely changed the availability of cheap credit and cheap money. That is gone. I think that risk is being repriced, and will be repriced sensibly. And I think the amount of leverage that we have soon will definitely not be the case. But we do believe that global growth will remain strong, domestic growth will remain strong, earnings still remain reasonably robust, commodity price outlook is strong, and valuations still, while they have moved up a little, still relatively supportive. So our view is that certainly the outlook still remains reasonably positive for the equities market over the coming period.
There's certainly been a fair bit of private equity activity for both of you. Do you think it's going to continue at this stage? And what will stop it?
The major factor that has meant that private equity won't be a force is the repricing of risk and credit spreads.
What we have definitely seen is a peaking in that, and for the reasons which I think I touched on, also John echoed just then. The reality is that the private equities did have a very good window, an opportunity there, which is now passed, I think. So, but it doesn't mean that mergers and acquisitions won't occur. I think there will be ongoing in-industry acquisitions, and I think that will be a trend over the next 12-18 months.
I'm wondering whether you've seen much foreign participation in the equity market over the last 3 to 4 months, given that the economic outlook still says Australia is a pretty good place to be.
It's difficult to gauge. I think there has been a fair bit of hot money come out of the market, a lot of leverage money which can be classified as international as well. There has been a lot of money that was in and out of the market because of the yen carry trade, which is often referred to as, and I think that could be, again classified as international money. As far as international investors are concerned, I think they're quite selective in what they're acquiring, because bearing in mind that international markets don't look expensive either. So.
I do agree with Paul. I think a lot of the hot money turned tail quite quickly when 2 or 3 weeks ago, and there was a lot of pretty aggressive panic type selling in some of the more leveraged names, and it was quite indiscriminate, even to QBE and some of the banks, where it just became an issue of liquidity. And also in names like, I think Orica was a good example, where the hedge funds bought the stock at 32, drove it to 35, and the expectation is that there'd be another deal, and they were selling it 2 months later it got down to 23. So they're just a few examples of where there were some reasonably obvious signs.
A couple questions. If there were a deep recession in the US, who'd be the winners and losers in Australia from a sector standpoint, company? And what else could derail China besides a recession? What's the major risk?
The sectors that would be hit substantially would be those sectors which are leveraged to that growth, which would be resources in particular. So that would be a sector that could suffer. I guess the ones that wouldn't suffer as much are your more defensive type and good value companies. But if we did see a substantial pullback in economic activity and it lasted for quite some time, it would actually impact quite negatively towards equities right across the board. As far as China's concerned, I guess the real risk is not necessarily the US, because the China is becoming far more self-sufficient. So again, I mean, if that's the case and China does slow quite dramatically, the impact would be definitely in the resourcing.
Anything that's leveraged really is it's the main they're the main kind of stocks to be affected in both of those environments.
Terrific. I think you have covered it all perfectly. Please join me in making